Good morning, welcome to Catex TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Friday, July 23rd, 2010. It's 11:30 a.m. Eastern Daylight Time in the U.S., 4:30 p.m. in London. In Beirut, it's 6:30 p.m., and in Mexico City, it's 10:30 a.m. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CatexTV. We have a little bit of a breaking story here. It literally came in about 2 minutes before we walked in the door. It's coming from the Washington Post. If you're an attorney involved in the Deepwater Horizon disaster in the Gulf of Mexico, you're looking for a smoking gun. Here it is. Dateline is Kenner, Louisiana. Long before an eruption of gas turned the Deepwater Horizon oil rig into a fireball, an alarm system designed to alert the crew and prevent combustible gases from reaching potential sources of ignition had been deliberately disabled. This is according to the former chief electronics technician on the oil rig. Michael Williams, testifying today in front of a federal panel investigating the disaster, said he understood that the rig had been operating with the system in, quote, inhibited mode for a year to prevent false alarms from disturbing the crew. Williams said the explanation he got was that the leadership of the rig did not want crew members needlessly awakened in the middle of the night. Boom. Gross negligence if I ever saw it. Anadarko, they're celebrating there. They're not going to have to pay. We'll go to our stories then. Well, this picture is well known to you. He is the epitome of sartorial splendor, but you can't overlook the fact that he's a bit of a street fighter from Trenton, New Jersey. This, of course, is Joe Plummerai, CEO at Willis. And boy, has he come out fighting about Aon's decision to go back to accept contingent commissions. These are going to be some remarks from a press release that Willis released, and you can be darn sure that Mr. Plummerai reviewed this personally with a red pen. Willis says that Aon's decision to resume accepting contingent commissions, as Aon said, where appropriate and legally permissible, takes broking, Willis says, deeper into the morass. Willis claimed it was the world's only insurance broker to refuse to accept contingents in his retail business. As we said yesterday, Willis said, Aon's overdue and muted announcement floated in mid-summer should come as a wake-up call to all risk managers and buyers of insurance to reevaluate whether their broker really works for them or for the insurance carrier. Quote, offering opaque statements about doing what is, quote, legally permissible, another competitor, meaning Aon, has opted to put contingents before principal. Willis puts clients before contingents. The press release goes on to say clients' best interests are served when their brokers work for them and only them, with standards of service based on ethics and integrity, not merely on what's, quote, legally permissible. This is all from the Willis press release. Willis described contingent commissions as backdoor payments. Went on to say a retail broker cannot serve two masters. They either represent the client or the carrier, but they can't do both. The recent history, Willis continued, of broker behavior and regulatory oversight in the insurance industry is not a proud one. And to sum up, Willis goes on and says the permissive rules that have fostered rampant conflicts of interest have returned, and with them an industry environment that's headed deeper into a morass and bound for more trouble when legally permissible is the new standard of excellence. Our industry can do much better by its clients, and clients should demand better from their brokers. There's a certain amount of Mr. Plummerai's intention is clear, trying to note that Willis may have some competitive advantage with prospective clients, but there is no mistaking the tone of this release. This is very, very unusual. These are two publicly traded companies who are essentially involved in a spat. We'll see if Aon decides to respond or not. I don't know what I would do if I was Aon. Well, the rest of the world financially is waiting to see the report card coming in from Europe about European banks. European officials are set to release the results of a series of so-called stress tests this afternoon on 91 banks across Europe. Now, European regulators are due to announce the results today. They have not come out yet, following the assessments on whether the banks could survive future economic shocks like the debt crisis in Greece. The banks that fail the test will be made to raise additional capital. Analysts have said that restoring investor confidence rests on how much detail is published about the bank stress tests. The London-based Committee of European Banking Supervisors conducted the analysis. An economist with global insight in London, Jan Randolph, said that the tests are aimed at identifying the fragility of European banks. He said, quote, "The whole point of this exercise is to sort the good banks from the needy banks, those that need capital and those that don't. What we're really concerned about is the larger banks," he said, what kind of exposure they have to property, past toxic assets, subprime problems, and also the exposure to sovereign debt. These banks have to reveal more than they have already. Unless they do, suspicion will remain. It's still not out yet. There's some concern that the test may have only been focusing on a certain portion of the bank's portfolio, so some concern has been expressed already, and the results aren't even out yet. Beazley made some news. The Lloyd's insurer, which is domiciled in Ireland, stated that the market is softening, yes, noting that capacity in the market is plentiful, yes, but CEO Andrew Horton noted that they actually made some money. They posted a pre-tax profit of $115.5 million US for the first half of this year, up from $30 million in the same period last year. That's a big improvement. Gross written premium was $941 million. It was $895 million at this time last year. Their combined ratio picked up a point, went from 90% to 89%. The growth on gross written premium was attributed mainly to growth in the reinsurance and specialty lines divisions. Premium rates did decline by an average of 2% across Beazley's whole portfolio. The insurer said that the marine office that had opened in Oslo in January had gotten off to a very positive start, and that they continue to see marine as a profitable business. Good job by Beazley. And you've got to hand it to these guys in Paris. As of a phoenix rising from the dead, SCOR said yesterday it had enjoyed a truly excellent June renewal period for its non-life and treaty business. It resulted in a 19% premium growth at constant exchange rates. They said their renewed business had shown an average price increase of only 1%, but pointed out that renewal conditions differed by sector and market. The company added that reinsurance prices had remained disciplined despite certain overcapacities. The end of June renewals represented about 10% of the company's treaty business and showed a continued rebalancing of its P&C treaty portfolio, tilting toward the U.S. and Asia-Pacific regions. P&C renewed premiums came to about 128 million euros, up about 22%, while premiums for specialty treaties jumped about 15% to 117 million euros. CEO Victor Peña said in a statement that the renewals demonstrated the dynamism of the company's underwriting teams and the confidence of their clients. They are truly excellent. SCOR continues to stick by their 2010 numbers that they predicted back in January, which called for gross written premiums projections of about 3.5 billion euros and combined net ratio of about 96%. So when you look at where they were 2 or 3 years ago, this is truly eye-opening. Insurance Day is reporting today that 6 countries have now committed to join the soon-to-be-launched European cat insurance facility, with a risk modeler scheduled to be on board in the fall. Europa Reinsurance Facility Limited, which will be known as Europa Re for short, has now received confirmation from Georgia, Armenia, Macedonia, Serbia, and Bosnia-Herzegovina that they wish to be part of the cat insurance program, which is going to launch in the spring of 2011. Albania had already confirmed it was planning to join Europa Re. Europa Re will become the first multi-country insurance facility to offer parametric and indemnity-based cover. Each member will kick $5 million US into Europa Re. That'll bring it up to $30 million by the end of the year. That will allow it to receive a license from the Swiss Financial Market Supervisory Authority. The World Bank is involved in this. The bank indicated that the risks that the cat products are going to cover will include earthquake and flood indemnity products, as well as index-based weather